Today, we are talking about the 5 biggest mistakes that retirees with $1 million nest egg make. They are mistakes that drain money out of their cash flow, also out of their net worth. And I've got a retirement income specialist, Scott McRae, here today. Scott's with the McRae Agency in Little Rock. And welcome, Scott.
Hi, good to be here.
So, let's dive right into this. What would you say is one of the biggest mistakes that retirees with $1 million nest eggs make?
Really, when they've got $1 million, you've got to realize you've taken risk all of your life, and so you're used to taking risks. And a lot of people, as they get older, they continue to take risk. So you've already reached the top of the mountain. You've heard the Mount Everest story before. Nobody dies going up the mountain; they die coming down the mountain.
Mm,
So when we're looking at distribution and we're looking at having $1 million with Social Security and all the other things, we have to be very safe about whether we're using that to buffer in the market, whether we're using that for income. What are we doing with that money? So a lot of people stay in the market a little too long, and there's nothing wrong with the market, but it depends on your age. So I think that's number one risk for me.
got it. And I've heard you talk about like balancing the seesaw that like
Absolutely.
having some money in the market is okay, but and I know we've got kind of a traditional model that says you should be in stocks and bonds, but I know that you've got a different perspective on that.
Yeah, of course, depending on your age. I know the pension plans prior to the 1980s, when they would guarantee you a certain income at a certain age, it wasn't a defined contribution, it was a defined benefit.
Mhm.
So they would put automatically for you part of your money into safe investments and part in the market. And as you got older, they would switch that seesaw. More would go toward the safe money and less in the market. So as it's more of a fluid effect as you're growing older, and they never really do that anymore. It's all in the market, all done. So if you retire while the market is up, that's wonderful, but you have to have your timing perfect. If you retire when the market's down, that's not so good. So if you've already
Yeah.
got $1 million, let's take a look at the balance. Let's take a look at your age. How much do you really need in the market? How much do you need in the safe money? When I look at income, if we have a guaranteed income, that makes it easier to make that decision on the seesaw. So to me,
Absolutely.
a little of both, but depending on your age, depending on timing, depending on the environment, black swan events, there's so much to look at, but we have to
Yeah.
guarantee that income.
Yeah. And anybody who's still relying on bonds, I would encourage you to have a conversation with somebody like Scott because there are other options for contractually guaranteed income that's typically going to exceed what you can get with bonds. And I think generally with less risk as well.
Absolutely.
So, let's talk about taxes. What mistakes do you see people making with
Wow.
taxes?
Taxes, whether you pay me now or pay me later, as the government says,
Uh-huh.
if you're saving money in a Roth, that's fantastic. Unfortunately, we're limited on Roth. So you have some in non-qualified, you have a lot in 401k, 403b, things like that. So a lot of times if you're taking income now and you're not deferring it to later, you may
Hmm.
be pushing yourself into a higher tax bracket. So we need to look at, or you need to look at, how much money are you currently making? How much do you need to live on? How much have we projected? And how much of that is guaranteed? Because if you're paying the taxes now, but you're not going to pay them later, that can be a good thing. But if you're deferring till later, that's a good thing now, but may not be a good thing later, depending. So it's a seesaw effect there too. We really
Yeah.
got to look at the total picture of your lifespan and what day, not what day, but what year you're going to retire, and how we're looking at what you've got now and project what you're going to have then and what the tax brackets may or may not be.
So when people go to get their taxes done, I've heard this that like your tax preparer, they want to be the hero and show you how much money they're saving you this year. Do
Right.
people sometimes get bad advice for long term from someone who's trying to save them a little more this year, but then they end up just deferring more pain down the road?
Yeah, there's things that we will talk about later. For instance, income rate monthly adjustment amount, IRMAA. If you're putting that all into an IRA because you don't want to pay taxes on some of it today, you're pushing it to later. That IRMAA bracket could get you, and we'll talk about that later. But that's a huge factor. But also, when we're looking at lifestyle, right now you're making money,
Hmm.
you're healthy, you're able to make more money. You don't need that money to live on right now. Why not pay your taxes now? This is my opinion on some of that money now and put it back tax free for later.
I agree with you, like using a backdoor Roth or something like
Yes,
that. That
because
I
later
agree.
on, what if you're sick later on? What if your spouse is sick later on? What if things change and you can't afford to pay those taxes then? Which would you rather do? Pay them now when you can and you don't need the money? I mean, we all need the money, don't get me wrong. But I mean, you could afford not to use that money and pay the tax now and make it tax free later to avoid all the other traps that we'll talk about later.
Yeah, I know that, inflation's high and a lot of people feel strapped right now, but like you say, is it easier to pay something when you're working, versus when you're not? And I
Yes.
think psychologically it's also extra hard. Do you see people leaving money in that traditional Roth, not traditional Roth, that made most no sense in a traditional IRA or 401k because they just don't want to suffer the pain of paying the
Because
taxes, so the
everybody tells
problem
them,
gets
stick it in
worse.
there. But what you don't realize is if you put $10,000 into your 401k and you're in a 12% tax bracket, you're only getting $1,200 worth of gain or savings.
Mm,
You're not getting the 10,000.
mm.
So a lot of
Hmm.
people don't realize that. And that other, the 12 is good, but the other is going to just sit back there and get paid later, which could be a huge problem.
Yeah, yeah. So let's get into the IRMAA question, because I know that's something some people may not even be familiar with what IRMAA is, but you've shown me some really frightening, numbers that'll keep you up at night in terms of how costs from your Medicare, which is what IRMAA is, can end up basically swallowing or depleting your social security. Tell us what IRMAA is
It
and
scares me
what.
too. It
Yeah.
scares me too. What it does, depending on your level of income later, when you
Mhm.
start taking income, IRMA has brackets, and you 1 through 5 or 6, something like that. I can't remember exactly how many they have, and that can change at any time. I mean, all the legislation is going to change in 2028 anyway. So we look at that and go, well, even though we're doing this now and we're deferring taxes for later, if we have to go into Medicare, we can't not, we have to take Medicare.
Mhm.
So if you're making a certain amount of money, you hit that first IRMAA bracket, and they're going to take that out of your Social Security to pay that fee. Well, what happens is as you make more and more money, they keep taking more and more fee until your Social Security is gone. And I know that's horrifying. But even after your Social Security is gone, they're still going to charge you for Medicare. They'll send you a
Mhm.
bill. And we've got copies of people that got bills that said, we have exhausted your Social Security payment. You still owe us $7,000.
And one of the problems is that we have healthcare costs rising faster than the cost of living index and Social Security. So it's like
Right.
you've got a one monster's growing faster. The monster's growing faster than the income is.
I think
And
Medicare is increasing at 6.8% a year inflation. And our inflation, as far as Social Security, is like 2 point, our cost of living adjustment, 2.3, 2.5, something like that. So you're looking at 6.5 against 2.5. It doesn't take long for that thing to get out of hand. So
yeah, yeah. And I don't know if you might have given this already, the official name for, or what
Well, yeah,
IRMAA stands for, is income
took me a while
related
to get this
monthly.
down.
I just had to look it up. It's like I know what it is, but it doesn't roll off the tongue. Income
In,
related monthly
yeah,
adjustment
income
amount.
rate, monthly adjustment amount. So they'll give you
Yes,
the rate that they're
yes.
going to adjust your income monthly.
Uh-huh. So
And
you
there's
want,
no
is
getting
the
out of it.
solution? So what's the solution to that? You need to move your income into like the
Tax free.
non-taxable, the
Yep.
tax-free environments
We have a
as
lot
soon
of
as.
people that we convert them from IRAs or 401ks into Roths,
Mhm.
over a 4 or 5 year period of time before they retire.
Got it.
There's ways we could do that to really save them a lot of money, because the problem with converting to Roth is you have to pay that tax to make it a Roth. So we've got ways we could help you with that dramatically, but you have to get it done before. And there's a 2 year look back, I believe, on IRMAA.
Mhm.
So I mean, it's something that people don't realize, that it's going to be a tremendous problem for some, not for all, but high income earners, it's going to be a problem. And we've got
Got it.
calculators for that too. We can run your IRMAA calculator and tell you exactly what it will be.
Yeah, Scott's got some good calculators. Yeah,
Yes, I
very,
do.
very, very detailed. I love playing with calculators. I love going online and looking up the investment calculators, but that's like big picture stuff. And we'll get to that because
Yes.
I know that
We're
might
limited in time. I know.
be the biggest. But we're on to number four, and let's talk about staying liquid.
Oh my
Why
goodness,
do
this
you
is
need
huge.
liquidity in your retirement years?
Yeah, you've heard of keeping your powder dry.
Yeah,
Uh,
yeah.
I know in 2008, 2009, that when the last crash we had, a lot of people got decimated. They
Hmm.
lost everything. But the
Yeah.
people that had money sitting to the sideline waiting stepped in and bought those properties for 60% of value, 50% of value, some less than that. And then when the market came back, they sold those things. They made
Yes.
a huge fortune. And it could
And
be
you
the
know what?
stock market. The stock
In
market's
my
the same way.
in my last investment boot camp, nobody had heard that phrase about keeping your powder dry. So it's like a musket. It's like a rifle or a, musket uh, analogy where, you don't want to run out of your ammunition, and so you want to keep some of that, that powder, the gunpowder. You're keeping some of your gunpowder dry so that if the stock market crashes, if the house next to you is on sale for 50% off, that you still have some ammunition where you can go and
And
I guess it doesn't make
liquidity
any.
is huge. And that's why the problem with not, there's a lot of problems with everything, but the problem I see with the 401k and everything like that, there's penalties before, if you have to take it out before 59 and a half. So you pay that 10%.
Mhm.
Then there's taxes. Then if the market's down, you don't want to take it out. So the likelihood of you taking that money out and purchasing that house next door for 50% of value is very low.
It's very low if you've got all of your money like
Yes.
in the tax trap of a
But
traditional IRA.
if we can plan and process now and say, look, this is what we need for the future. Here's all my expenses. I know what I need. I know what I got. I know what I'm going to have. If we
Mhm.
can set some of that money aside and pay the taxes now while we can and set it aside, there's going to be a black swan event. There's going to be a down market. There's going to be a housing problem. There's going to be a divorce case down the street. And I hate that for people, but someone's going to buy that house. So
Yeah.
you might as well take advantage of it. So it's all in the proper planning and having some liquidity for those things, and then having some setback in your 401k, some setback in mortgage notes. I mean, whatever it might be. But I think the seesaw effect and having liquidity and options is a huge, huge advantage for a lot of people.
And this doesn't need to be although you might want some of it in a savings account, this
Mhm.
doesn't all have to be, because one of the problems with savings accounts is that, as interest rates go up and down, maybe one year you can get, 3 or 4%, but maybe in another year you're struggling to find a place where you can get 1%. I mean, we saw that not
Right.
too long ago. But you recommend using, we can use especially if you've got, this is great if you've got you've got a spouse, you've got a partner, you've got dependents, you can use a certain kind of a permanent life insurance policy where you can be earning 4%, 4.5%, and
That's net rate. Yeah.
yeah, that's net, and you can borrow against
Right.
that. You can
Yeah.
borrow
We,
against
we,
that
when we set these
policy.
policies up, they were not set for everybody like this, but for investors, we're
Mhm.
looking at doing a right below the IRS limit, because the
Mhm.
IRS said that at a certain point, your life insurance is so cash rich. Now it's an investment. Now you have to
Mhm.
pay taxes. So
Mhm.
we use that modified endowment rule and keep it right to the top of that line to where it's really cash rich and really low in death benefit. So we use the minimum amount of death benefit and the maximum amount of cash. But by doing that, the cash value explodes in that thing. And we have to check it
Yes.
every year to make sure it doesn't get too high. But by having a mutual company, we can call the company and say, I've got $100,000 in this policy. Loan me your money at 2.5%, 3% net after we get through with everything. And I'll go use your money to buy that house. And in the meantime,
Mm.
your 100,000 is still making 4.5%. So it's kind of double dipping, and we have to design it properly. But by
Mhm.
doing that, it really can make a lot of money. And then also you can use that life insurance to replace some of the term that you're spending money on now.
Yeah, yeah, because you can
Yeah.
move from the term to the permanent if that makes sense for you. And I know for a lot of investors, real estate and whole life insurance, the a specifically designed type of policy can be a good combination.
Yeah. It's great. And of course, there's some, if you can find a bank that would do that for you, and
Hmm.
there may be, I've heard of some credit unions that were offering 4.5% in a savings account, and they would use that as collateral to loan you their money, which would be kind of the same thing without the death benefit. But if you could find that, that would work as well, because you're using someone else's money to make money while your money still grows in that spot it's at.
You can also, there are also banks, I understand, that you can use a policy as collateral and you can borrow sometimes for less than
You
what
sure can. Yeah.
than what the policy loan might be for.
Called a
Anyway,
collateral assignment.
I want to move on to what I think is perhaps the biggest mistake retirees make, especially, well, the more money you have, the bigger of a mistake this might be. And it is not tracking your numbers and not running your projections. So everyone's out there kind of guessing, what their investments are going to do, guessing what their investments have done. You encourage your clients to call up their brokers or their advisors and ask a certain question. Tell us about that.
And it's so difficult sometimes, and I don't know why. I think the intimidation factor from your broker, which I don't know why there's an intimidation factor. You should be friends with your broker, but
They
instead
ought
of
to be working for you.
yes, they're working for you. Without your money, they don't have a job. So instead of taking the statement and going down through it and figuring out where this was and where this was, just call your guy and go, I need to know where I started. What was the amount of money I started with? How much has been put into my account over these years? And how much I have today? Then we could use a simple calculator and tell you what the real return of that is, not the average, but the real return.
Hmm.
But it is so hard to get people to do that. But people, it's your money. Just call and ask the
Yes.
question. The broker should be proud to give you that information because you go, hey, you started here. Look what I got you now. That's what he should be doing. And hopefully that is what he will do.
Hmm.
But just use that question and we'll find out
Yeah.
really fast how you're actually doing.
Yeah. I know some people that know what they're earning, and a lot of people, they'll look at their account 10 years later, and sometimes they know how much they've put in, and they're like, why isn't this growing faster?
Yeah.
So it's really important to track your numbers, and just as important as tracking your numbers is running projections.
Yeah. And the only way you
Talk
can run a
about,
projection is to know what you're making.
mm,
If your real return is 4 or 5, hopefully. But when they call, they tell you the average return is 12. There's a difference there. We'll show you how that works. But if the real return, money in your pocket is 4 or 5, that's what you need to use for the projection.
Mm,
because that's what
mm,
you're going to have when the time comes, not the
okay.
average. So yeah, it's just basic questions that you can use that will really nail down how much money you really have and how much your projection really is and how much truth is going to be there when you're retired.
Hmm. And you're not just running projections. Obviously, you want to run them on your, you might have investments, you might have annuities, you might have different kinds of things, but also, does your software cover things like Social Security and, what that's going to look like and what your tax brackets? Obviously, tax brackets can
Yep.
change if the government
Yep. Great
changes
question.
them.
Our software is updated each year with the taxes, from the government.
Mhm.
But yeah, when you're running those projections, and we're looking at real return. And what was the first question you asked? I'm sorry, I just lost it.
Oh, got it. I think I was asking if it covered Social
Oh yes,
Security
yeah, I'm sorry.
and taxes.
Yeah,
Yeah.
yeah, we look at your full retirement age, and if you don't have the report, we'll log on with you. And once we find your full retirement age, we put that into our Social Security calculator, and that will tell us how much you'll have if you retire at 62, 63, 65, 66, 67. Because full retirement age for a person may be 65 if they're a little older, or it may be 67 like mine is. And I'm a little older, but I'm not as old as some and not as young as some. So we have to find out what your FRA on your report is, plug that into the calculator. It'll tell us exactly how much Social Security you have coming at whatever point, and we can use that to make accurate projections.
FRA, is that full retirement amount? What
I
is,
think it's full retirement age.
oh,
Yeah,
full
but it'll give
retirement
you an
age.
amount
Okay.
though. It'll give you an amount at full retirement age.
Got it. Yeah, and then probably people need to be looking even at family health history and that sort of thing. That
Yeah.
my and the deeper I dig into this, I realize that there's not necessarily one correct answer for everybody, but it is very, very individual.
Yeah. To me, the numbers, the linear, everything's there, but also how do you feel about what you're doing? What do you want to be? I mean, do you want to retire and be happy? Do you want to be, you know, taking vacations? We have to put all that in your plan early. This is
Mhm.
my plan. I want to spend 5,000 a year on vacations, whether I take them or not. I want to set that in my numbers.
Mhm.
So later on, you'll have, if you didn't spend it all, great. But if you did, hopefully you had a good time. So life's not about just money, you know. And so we also want to make sure that everybody, that money is, if you're doing a pension from work, make sure that all that pension is transferred to the spouse at the first spouse death.
Mm.
Things like that. It's just little things, which are big things that you need to look at with your planner to make sure all those things are nailed down solidly. So you'll know exactly where you're going to be.
Got it. Well, I know we're going to be doing a class, an in-depth class. We're going to make Scott get out his calculators and work really hard. Where we're going to be looking at IRMAA and reducing taxes, especially reducing your costs. I didn't think for us to set up a date for that before we recorded this, but just leave a comment below if you want to reduce your costs in retirement. We can invite you to that class. I'm also leaving Scott's information in the description. He is with the McRae Agency in Arkansas, and I encourage you to set up an appointment with Scott and explore further and get those numbers, like run those numbers that sometimes we have so much anxiety, just like not even knowing, not even understanding what's happening with our money, what will be happening with our money. And you want to be proactive. And Scott is definitely somebody that can help you be proactive. So I've got all of his contact information in the description. And thanks for being here. I would love to know your takeaway of the five biggest mistakes retirees with $1 million portfolio make.
Yeah, absolutely. Thank you. I've enjoyed it. I look forward to coming back.